With the Fed continuing to raise interest rates to tackle out-of-control inflation, this could spell a disaster for the job market and lead to a surge in unemployment in the near future. The economic data has already started to turn, with many companies starting to lay off some of their workforce and less companies hiring in general right now. But this could be about to get a lot worse very soon. Today I'll be looking at how interest rates and unemployment are connected, what the current economic data is suggesting, and the future outlook for the unemployment rate and job market. So let's first take a look at the rising interest rate problem. Right now, the economy is seeing continued high inflation, which in turn is forcing action from the Fed in the form of rising interest rates. Now, high inflation and high interest rates are both bad for the job markets, and as the interest rate goes up, unemployment does tend to follow. So when interest rates are higher, consumers are less likely to take out loans to spend money and are more likely to save more money in the bank to take advantage of the high reward that they're going to get for saving money in a bank. And with less money being spent in the economy on goods and services by consumers, businesses do start to see their profits shrink and the overall health of many businesses does suffer. So on top of worsening trading conditions, businesses are also less likely to borrow money to fund business growth because a higher interest rate means that the cost of debt is more expensive. Now, all in all, this leads to many businesses in the economy suffering from less consumer spending and a high cost of borrowing. Businesses begin to streamline their process, trim their less productive areas, and turn their attention away from future growth opportunities. Now, this in turn leads to businesses hiring less new people, and in many cases being required to actually lay off existing staff to stay afloat in the turbulent economic conditions that they are facing. Now, that will only get worse if a full-blown recession does develop in the future. Historic data does back up this theory, and if we look back across the last century, we can see that the unemployment rate is highly correlated with interest rates, and as interest rates get higher, unemployment usually follows, lagging behind by a few years or so. Now, highlighted on this graph, we can see that the unemployment follows the rise in interest rates between 1960 and 1980. Now, the two both then trend downwards between 1980 and the early 2000s, before they both rise again between the early 2000s and 2010. So there is a clear trend taking place here, and whichever direction the interest rate does head, unemployment is following closely behind. So this historic data is yet another pointer that suggests that we're about to see a surge in unemployment. So interest rates have risen from basically 0% a couple of years ago to now being over 2.5%, and meanwhile unemployment has been continually trending downwards, now at one of the lowest levels it has been in history at just 3.5%. And this historic data is obviously pointing to the fact that unemployment is likely to go up if it is to follow the trends that the interest rate is going in. So now let's have a look at some recent economic data around the job market and how it is starting to turn. So there were 30,000 job cuts announced in total for the month of September across US-based employers, which was up 46% from August and up 68% year on year. Now, aside from tech companies, there have also been many job cuts amongst mortgage and lending staff because of the cooling housing market, Fed rate hikes, and also recession concerns. So meanwhile, hiring intentions, which measures the number of new jobs employers plan to add in the future, have fallen to their lowest levels since 2011. Now, this data does also suggest that the retail and warehousing companies that typically prepare for the holiday season by increasing their staff levels are holding back now and waiting to see whether consumers will actually be making purchases this year. The number of jobless claims jumped by 15% at the end of September to 219,000, which came in higher than projected. A chief economist at Pantheon Macro said that the rising claims aren't indicative of a changing trend just yet. However, claims could continue to rise in the coming weeks, and as unemployment increases, the number of people claiming benefits for being jobless is going to rise, and the overall economy is going to be less prosperous, and there is a reduced buying power across American citizens. The number of job vacancies has also been slashed by US employers, with over 1 million job vacancies being cut in August, making it the second sharpest monthly decline in 2 decades, only behind April of 2020. So job vacancies is a key measure of labour demand and now stands at just over 10 million after this August decline, meaning that there are less US companies who are actively recruiting for roles right now. So this decline in job vacancies will provide some relief for the Fed, who are in the middle of aggressively tightening monetary policy. So it is one sign that their interest rate hikes are starting to actually work as intended and are starting to have an impact on economic metrics. So less job vacancies is a sign that business growth is slowing and earnings are being slashed, which ultimately means that inflation will start to come back down to earth, with there being less money sloshing about in the economy, both from a business point of view and also a worker point of view as well. So businesses have less money to invest in business growth and therefore won't be able to hire as many people, and the US workforce will suffer from less job choice and growing unemployment as well, which means that they will have less buying power on average across the economy. So now let's take a look at the future outlook for the job economy, as well as some predictions as well. So Bank of America has come out and warned everyone that they believe that the US economy will soon start to lose 175,000 jobs a month, beginning early next year. They think that the Fed's fight to squash inflation is the main driving factor behind this, and they don't believe that the Fed will be able to tackle this inflation without causing significant and persistent job losses. So Michael Gapin, head of US economics at Bank of America, did also add that we are looking at a harder landing rather than a softer one, and we are looking for a recession to begin in the first half of next year. Gapin also does expect that the unemployment rate will climb to somewhere in the region of 5% to 5.5% over the course of 2023, and this is up significantly against the current unemployment rate of around 3.5%, and is also higher than the 4.4% unemployment rate that the Fed is expecting to see in 2023. In a survey of economists carried out by Wall Street Journal, on average it was predicted that GDP will contract by 0.2% at an annual rate for the first quarter of 2023, followed by a 0.1% contraction in the second quarter. So employers are expected to respond to lower growth and weaker profits by cutting jobs in the second and third quarters, and the average estimated loss in jobs is 34,000 a month for Q2 and 38,000 a month on average in Q3. So these economists also believe that unemployment is going to rise as a result of rising interest rates, with the prediction being that unemployment will rise to 4.7% by the end of 2023 and will stay at around this level going into 2024. Now, certain sectors of the economy are inherently going to be impacted more than others when it comes to layoffs and lower job vacancies. Now, as mentioned already, the mortgage and lending sector is being hit particularly bad right now, but the tech and startup sectors were hit with large-scale layoffs in the summer as well. Now, it's clear that many tech companies did overhire during the pandemic when technology became a crucial part of everyone's life, and this was only exacerbated by the fact that interest rates were particularly low in 2020 and 2021 as well, which allowed companies that weren't profitable to borrow cheap money. Now that the world is largely back to normal and that tech has become less important, as well as the fact that unprofitable companies are also now being hit with debt being much more expensive, it was inevitable really to see that layoffs would take place in these particular sectors. So money is only going to get more expensive in the future, and economic conditions are likely to continue to worsen into a probable recession, which means that there's going to be more of a struggle ahead for many tech companies, especially the ones that are unprofitable right now. It's therefore quite probable that we will continue to see more layoffs in the tech sector, as well as many startup companies as well. So overall, as the interest rates are being raised by the Fed, it's certainly looking likely that the unemployment rate is going to rise as well to follow this trend and the correlation between the two metrics. The economic data is already starting to turn, and we're seeing more people get laid off and less job vacancies available in the economy. And many large financial organisations like Bank of America are also predicting that the job losses are going to start to rise as well in 2023, driving up unemployment even more. Now, obviously, the topic of people losing their jobs and unemployment going up is not a nice topic to talk about, and it's obviously a very bad thing if unemployment does go up. So I think certainly everyone is hoping that the hit on unemployment is not too strong, but it's obviously important to look at the economic data and what it is suggesting in the future, just so people have got an idea of where things are likely to head, and maybe some people can actually prepare for this as well. So that is all for today's video, guys. I hope you did enjoy the video and found it useful. Please do bear in mind that this video is purely based on my own research and my own opinions. It's not financial advice, and I'm not a financial advisor. It is for purely entertainment purposes only. But aside from that, please remember to leave a like if you did enjoy the video, as that does help out the channel a lot. Also drop me a comment as well. Let me know what your thoughts are on the current state of the job market and where you think unemployment could be heading in the future. Also be sure to subscribe as well if you want to see similar videos to this in the future. And apart from that, guys, thanks a lot for watching.